There is a particular kind of financial life that looks, from the outside, like success. The house is decent, the car is reliable, the kids are in good schools. The vacations happen, maybe not every year but often enough. The salary is respectable, maybe even impressive by some measures. And yet, underneath all of it, underneath the appearance of stability that the middle class has spent decades learning to project, there is a current of quiet anxiety that never quite goes away. A feeling that despite doing everything right, despite working harder than the generation before, despite following every instruction given by every financial institution and authority figure encountered along the way, something is not adding up. The gap between where you are and where you thought you would be by now keeps refusing to close. And the most disorienting part is that you cannot point to the catastrophe that caused it, because there was no catastrophe. There was no single dramatic failure, no obvious mistake, no identifiable moment where everything went wrong. There was just the slow, steady accumulation of decisions that felt reasonable, even responsible at the time. Each one made in good faith, each one quietly compounding in a direction that nobody warned you about. This is the story of those decisions. And understanding them might be the most financially consequential thing you do this year. The first mistake is one that runs so deep it has become invisible, mistaking a growing income for growing wealth. These are not the same thing, and the difference between them is not subtle once you see it, but it is entirely invisible until you do. The middle class, almost by definition, is income dependent. Income pays the mortgage, funds the lifestyle, covers the school fees, services the debt, and produces the feeling at the end of a good month that things are working. And when income rises, the natural, almost involuntary response is to let the lifestyle expand to meet it. A better car, a bigger house, a nicer neighborhood, more comfortable versions of everything already being consumed. This is called lifestyle inflation, and it is so deeply embedded in middle-class culture that it is not even perceived as a choice. It is perceived as the reward for working harder, as the natural progression of a successful life, as what rising income is supposed to produce. But what it actually produces is a life that is more expensive to sustain at every level, more vulnerable to any disruption of the income that funds it, and no closer to financial independence despite the higher numbers on the paycheck. The person earning $50,000 and spending $45,000 is in a fundamentally different financial position than the person earning $100,000 and spending $9,000, even though the second person would almost universally be considered more successful by any external measure. Wealth is not what you earn. It is what you keep. And more specifically, it is what you keep in forms that do not require you to keep working in order to maintain them. The second mistake is one that the entire consumer economy has invested enormous resources in encouraging, and it has to do with the relationship between debt and identity. The middle class carries debt the way a fish carries water, so completely surrounded by it that the medium itself becomes invisible. Mortgage debt, car loans, student loans, credit card balances, home equity lines, personal loans, each one entered into for reasons that seemed individually reasonable, each one carrying an interest rate that extracts a quiet, continuous toll, each one shifting a portion of every future paycheck towards servicing the past rather than building the future. What makes this particularly insidious is the way the financial industry has normalized not just debt but expensive debt, the kind that carries interest rates high enough to genuinely alter your long-term financial trajectory. Credit card balances at 18 or 24% are not financial tools. They are financial anchors. They represent a tax on every purchase made with borrowed money, a tax that compounds daily and grows without requiring any additional decisions on your part. And yet they are marketed as convenience, as rewards, as sophistication, as evidence that you are a consumer who has earned the right to access the future's money today. The people who profit most from this arrangement are not the people holding the cards. They are the people issuing them. The third mistake is the one that costs the most in aggregate, across a lifetime, and it is the one that almost nobody talks about directly. The failure to understand what inflation actually does to the financial plan you think you have. Most middle-class financial planning operates in nominal terms, in the raw numbers on the account statements. The face value of the savings, the dollar amount of the retirement target. This number needs to be this large by this date, and if the number reaches that level, the plan has worked. But inflation is continuously redefining what every dollar in that plan is worth. In real terms, and the plan itself never adjusts to account for this unless the person managing it understands why it should. Inflation is not a mystery. It is a policy, a deliberate, explicit feature of how central banks manage modern economies. The Federal Reserve, the Bank of England, the European Central Bank. These institutions do not target zero inflation. They target positive inflation, typically around 2% annually, as a design goal. They want prices to rise. They have reasons for this that are technically defensible within their own frameworks, having to do with debt management, economic stimulus, and the avoidance of deflation. But what this means for the middle-class family, carefully saving their way toward a future goal, is that the goal is moving. Every year, the purchasing power required to meet that goal increases. And every year spent saving in instruments that do not keep pace with inflation is a year of backward progress, dressed up as forward momentum. The retirement account that grows by 3% in a year when inflation runs at 4% has not grown at all. It has shrunk. And the middle class, largely educated about money in nominal terms, largely advised by institutions that operate in nominal terms, largely rewarded with nominal interest rates that feel positive without being real. The middle class does this for decades and wonders why arrival never comes. The fourth mistake is subtler and more personal, and it lives in the space between what people know they should do and what they actually do with money when emotions are involved. Financial decision-making is not, in practice, the rational, calculated process that economics textbooks describe. It is deeply, irreversibly emotional, shaped by fear, status, anxiety, the desire for certainty, the discomfort of delayed gratification, and the very human tendency to weight immediate losses more heavily than distant gains. The middle class makes financial decisions in this emotional space constantly, and the decisions made from fear or status pressure or the discomfort of uncertainty tend to be systematically worse than the decisions that would be made from clarity. People stay in investments that are declining because selling feels like admitting failure. They avoid markets that are rising because the height feels dangerous. They keep money in low-yield savings accounts because the alternative requires tolerating the discomfort of not knowing exactly what the balance will be next month. They make major purchases, houses, cars, renovations, to signal status to communities, whose opinion ultimately has no bearing on their financial trajectory. Each of these decisions has an emotional logic. None of them has a financial one, and the aggregate cost of a lifetime of emotionally driven financial decisions, even individually small ones, is staggering in a way that most people only perceive in retrospect, when the gap between where they are and where the math said they should be becomes too large to explain away. The fifth mistake is one that the financial industry has made very difficult to see clearly, because the industry profits from the obscurity. It has to do with the true cost of financial products. The fees, the commissions, the expense ratios, the management charges, the administrative costs, buried in the fine print of retirement accounts and investment funds and insurance products that most middle-class families hold without ever fully understanding what they are actually paying for them. A mutual fund that charges 1.5% annually in fees does not sound expensive. 1.5% sounds like almost nothing, a rounding error on a financial document, but compounded across 30 years. On a retirement account that otherwise would have grown at market rates. The difference between a fund charging 1.5% and one charging 0.1% can represent hundreds of thousands of dollars in final account value. This is not speculation. It is basic mathematics applied to compound growth over time. The fee does not just take 1.5% of the balance every year. It takes 1.5% of the potential compounding of that balance, which means its true cost grows with the account rather than staying flat. The people selling these products are not required to present this calculation to you. They are required to disclose the fee. They are not required to explain what that fee actually costs across the time horizon relevant to your financial life. And so most people sign the documents, pay the fees, and never fully account for what the fees are extracting. The sixth mistake is one that connects money to time in a way that most financial education completely fails to address. And it is perhaps the most clarifying insight in this entire conversation. The middle class trades time for money, almost exclusively, as a fundamental operating principle. You work, you are paid, and the payment stops when the work stops. This is not a moral failing or a character flaw. It is simply the arrangement that the middle-class economic life is built around. But it creates a structural vulnerability that never resolves itself through more work, because more work produces more income than is subject to the same vulnerability. The wealthy, not the aspirationally wealthy, but the structurally wealthy. The people whose financial position is self-sustaining have arranged their financial lives so that money works while they sleep. Dividends arrive, rents are collected, royalties accumulate. Businesses generate revenue that does not require the founder's daily presence. None of these arrangements require being born rich. They require understanding that the goal of financial life is not a higher salary but a wider gap between what you earn while working and what you need to sustain your life. Deployed deliberately into things that generate returns without requiring your continuous labor. This is the concept of passive income. But stripped to the way it is usually discussed, the overnight marketing, the social media performance. It is simply the difference between owning something that produces value and being the thing that produces value. The middle class, in general, is the latter. And moving from one category toward the other is not a single decision, but a direction, one that requires understanding the difference. First, the seventh mistake is the one that holds all the others in place. The one that makes each of the previous six not just possible, but almost inevitable. And it is a mistake not of action, but of attention. It is the failure to treat financial education as something worth pursuing, seriously, continuously, and with the same rigor applied to professional skills, parenting decisions, health choices, or any other domain of life that genuinely matters. The middle class, as a cultural formation, has been systematically undereducated about money, not because money is too complex for ordinary people to understand, but because the entities with the most influence over that education have the most to gain from a population that does not understand the systems it is embedded in. Banks benefit from customers who do not understand the real cost of carrying a balance. Investment firms benefit from clients who do not understand expense ratios. Real estate developers benefit from buyers who do not understand leverage. Credit card companies benefit from cardholders who focus on the rewards and not the rates. The ignorance is not accidental. It is, in many cases, cultivated through complexity, through jargon, through the construction of systems that are technically transparent but practically opaque, designed to be navigable by the people who profit from them, and confusing to everyone else. And the middle class, busy earning and spending and managing the logistics of a demanding life, has largely accepted this arrangement without demanding the education that would change it. What ties all 7 of these mistakes together? What gives them their collective power to hold an otherwise capable, hardworking, well-intentioned person in a financial position below what their efforts should produce? Is the relationship between the individual financial decisions and the larger monetary system in which those decisions are made? Most financial advice treats personal finance as though it operates in a vacuum, as though the right savings rate or the right investment allocation or the right debt payoff strategy can be determined independently of what is happening at the level of monetary policy, currency management, and institutional power. But it cannot. The middle class does not just make financial mistakes in isolation. It makes financial mistakes inside a system that has structural features, inflation targets, interest rate policies, tax code design, monetary expansion, that systematically disadvantage the financial position of people who earn income and save in cash, while systematically advantaging the position of people who own assets. Understanding this is not about assigning blame or surrendering to helplessness. It is about seeing the board clearly enough to play a different game. When the Federal Reserve raises interest rates, it does so to slow inflation to reduce the pace at which the purchasing power of money is declining. This sounds like good news for savers, and in some narrow sense it is. Savings accounts briefly pay better, but higher interest rates also increase the cost of borrowing, which means the mortgage becomes more expensive, the car loan becomes more expensive, the business loan becomes more expensive, and the middle-class family carrying debt, which is almost every middle-class family, finds that more of every paycheck is absorbed by the higher cost of the debt it already holds. The policy that is supposed to protect the value of saved money simultaneously increases the burden of borrowed money. And the middle class, with its characteristic combination of modest savings and significant debt, is caught in both directions at once. When rates are cut, the savings earn less, but the borrowing is cheaper. Another set of trade-offs that resolves differently depending on whether you are primarily a saver, or primarily a debt holder, or primarily an asset owner. The wealthy, with their diversified asset positions, tend to benefit from most interest rate environments through one mechanism or another. The middle class, depending on a single primary mechanism, earned income, tends to absorb the costs of each environment while benefiting inconsistently from the advantages. The house in question deserves its own attention in this story, because it sits at the center of middle-class financial identity in a way that makes it simultaneously the largest financial decision most families ever make, and one of the least analytically examined. Owning a home is not inherently a good or a bad financial decision. It is a contextual one, deeply dependent on the price paid, the financing terms, the local market, the opportunity costs of the down payment, the duration of stay, and a dozen other variables that most buyers never fully evaluate, because they are making the decision inside a cultural narrative so powerful that it feels like a moral imperative, rather than a financial calculation. In many markets over many decades, homeownership has been wealth, but in other markets, at other price points, with other financing structures, it has been wealth-consuming a vehicle for enormous debt, significant transaction costs, ongoing maintenance expenses, property taxes, and insurance, all of which must be netted against the appreciation before the true financial return of the investment can be calculated. The middle class, in general, does not do this calculation. It buys because buying is what you do. Because renting feels like wasting money, even when the mathematics of renting and investing the difference would tell a different story. Because the house is the symbol of arrival, and the arrival is the goal, regardless of what achieving it actually costs. There is a specific and rarely discussed way that the middle class loses financial ground across generations, not through spectacular failure, but through the quiet erosion of estate value. The assets accumulated by the middle-class generation, the house, the retirement accounts, the modest investment portfolio passed to the next generation through a process that is often inefficient, poorly planned, tax unaware, and structurally disadvantaged compared to the estate planning that the wealthy engage in as a matter of routine. The stepped-up basis provision, the dynasty trust, the charitable lead trust, the grant a retained annuity trust, these instruments are not secrets. They are openly available, taught in law schools, sold by financial institutions, but they require planning, professional guidance, and some initial complexity to implement, and the middle class, managing the daily demands of earning and spending, tends not to engage with estate planning until it is urgent, which is frequently too late for the most effective strategies. Wealth that took a lifetime to build is taxed, fragmented, and diminished in transition, and the next generation starts closer to the beginning than the previous generation's accumulation would suggest it should. The wealthy plan for this decades in advance. The middle class addresses it in the weeks after a diagnosis. What changes when you understand all of this together, not as 7 separate pieces of advice, but as a unified picture of how the system actually works, and where the middle class sits within it is not primarily your behavior. It is your orientation. It is the frame through which financial decisions are made, the questions that get asked before commitments are entered, the instinct to look past the nominal number to the real one, past the product to the cost of the product, past the income to the structure that generates it, past the financial advice to the incentives of the person giving it. Most of the mistakes described here cannot be fixed in a month or even a year. They are architectural, built into the way a financial life is structured, and restructuring takes time, planning, and the willingness to tolerate a period of transition between the financial life you have and the financial life you are building toward. But none of them can be fixed at all without first being seen, and seeing them clearly, without the comfortable reassurances that the status quo tends to offer at every opportunity, is precisely what most of the systems surrounding the middle class are not designed to help you do. The middle class is not stuck because it lacks intelligence, ambition, or work ethic. It is stuck because it is playing a game whose rules were written by people with different interests, using strategies designed for a simpler economic environment, inside a monetary system whose structural features create headwinds that personal virtue alone cannot overcome. The person who works harder inside a system they do not understand does not escape the system. They simply exhaust themselves within it more efficiently. But the person who understands the system, who can see where the friction is, where the extraction is happening, where the rules create advantages that can be accessed with knowledge rather than wealth, that person begins to make different decisions. Not perfect decisions, not risk-free decisions, but informed ones, which is the only category of decision that can reliably produce different outcomes from the ones the current path is heading toward. You have been inside this system your entire adult life. You have been making decisions within it, absorbing its costs, operating under assumptions about money and security and success that the system itself installed in you, without your full awareness and without your explicit consent. None of that is your fault. But awareness, once achieved, creates responsibility. The responsibility to ask better questions, to look more carefully at the arrangements you have accepted, to measure your financial life not against what your peers appear to have, but against what your own time and energy and intelligence, properly directed, might actually be capable of building. The 7 mistakes are not destiny, they are patterns. And patterns, once recognized, can be interrupted. Not all at once, not without difficulty, but interrupted, and slowly, deliberately, replaced with something more honest, more effective, and more worthy of the effort you have already been giving. The middle class is not a trap, it is a starting point. But only if you can see it clearly enough to know that you are standing in it, and that the exit has never been clearly marked because the people who benefit from the current arrangement have very little interest in helping you find it. You are looking for it now. That is already different. And different, in this context, is everything.